Welcome to the BankTalk podcast, the show where we talk to leaders and experts from the community banking sector. Whether you are a current CEO or aspire to be one, this podcast will give you valuable insights and advice on how to run your financial institution better. Each episode explores a new topic with a guest who brings their unique experience and knowledge. Tune in and discover something new each time you listen.
I'm Charlie Kelly, your host and partner at Remedy Consulting. Today, we've got Thomas Gilbraith from Barker, and Thomas is here to talk asset-based lending. As you know, we've been searching on BankTalk to try to find some use cases for AI and how AI might affect you as a community banker going forward. And Thomas and his team approached us and had some ideas on how asset-based lending is changing and what some AI tools might be doing within their space. So we thought we'd give him a listen and see if we can ask some intelligent questions and go from there. So without further ado, let's get to Bank Talk. Hi, and welcome back to Bank Talk. Today, I have Thomas Gilbraith with me from Barker. Thomas, thank you for joining me.
Thank you, Charlie.
So Thomas, because this asset-backed lending conversation is what it is, and it's slightly off of what I think community bankers do, let's start with a brief intro of who you are, where you came from, and what Barker is all about.
Yeah, absolutely. So I'm Thomas Galbraith, CEO of Barker, and we launched about 3 years ago to address like a very specific problem within asset-backed lending. Just very quickly, I can explain that within asset-backed lending, there's two primary risks, right? There's the borrower, which a lot of people are very good at underwriting and figuring out that risk. And then there's the asset. And the primary risk with the asset is the value of that asset. And historically speaking, you could ask 5 different valuation firms to value loan collateral, and you'd get 5 different prices, which doesn't really inspire confidence for a lender, right? So then they act defensively and all of those things. In addition to that, valuation firms also don't guarantee their prices. They actually kind of run away from the liability and they say that they're not liable and it's just their opinion and all of those things. So we decided to do a 180 on that. And we said, what if we use the best possible technology to deliver the most accurate price and then delivered that price in a contractual guarantee? So now the lender has a price they can trust for accuracy and also recourse in the event that we were wrong. So that's really how the company and the product came about.
Excellent. Okay, so I already have 5 questions that I should be asking you on that, specifically how that guarantee works. But I'm going to throw that in here somewhere. But let's start with, I just want to make sure that the audience understands asset-backed lending as you defined it, right? I was thinking before our prep session, we were coming in here to talk about receivables, and you corrected that a little bit. So just give me a better feel for what those assets themselves, what are they? Like, how do you...
Yeah, absolutely.
Tell me about that a little bit.
Yeah, it's funny. I find the fact that receivables are included in the broader world of asset-backed lending quite interesting because they're not really tangible assets. But anyway, it is. What could you do?
Sure.
So we focus entirely on actual tangible assets, right? So if you're a private individual who owns a home or luxury assets or some high value asset, then you might want to extract liquidity from that asset to put it to work in other places. Or you might be a business that owns commercial equipment or aviation or any of those other sectors where shipping, for example, where we're talking about real tangible assets that have a resale value. In those instances, then you're looking at tangible assets that have liquidity trapped in them. So you would go to a borrower and you would say, I would like to borrow against this asset because I want to take the capital and want to take some liquidity out and put it to work for another reason. Maybe you're using it for, as I said, a different investment or for your operating expenses, whatever it might be. And then the lender needs to say, okay, great, happy to do that, but I need to know what the value of the asset is. And that's where we come in. So that's what we think of when we think of asset-based lending.
Appreciate that. I think that's a great definition of the base. So the 2 things that just popped to mind as we were talking about this were this. Number one, that guarantee fascinates me because I would think in the commercial space that has to do with equipment and specifically, I was always under the impression that if I own a business and I have 8 machines, it's likely that I have a loan against those machines at some point. In
Yeah.
the scenario that we're talking about, are you saying that it could be a combination of new assets where they didn't need a loan and/or equipment that maybe has depreciated over time that does not have a loan attached to it? That would be sort of the asset base that you would use to allow a bank to offer for a loan against? That was a long question, but see if you could answer that.
Yeah, no, I know, all good. I get it. I think what helps here is to think through, like, what are the instances in which a borrower would need that capital, right? And typically they fall into 2 buckets. Bucket number 1 is they actually want to purchase the asset at the outset, right? So then they need financing. They need some kind of financing to help purchase the asset because they may not have that liquidity immediately available. And in that instance, obviously, we're coming in at the beginning. We're typically reviewing an asset, valuing an asset that is often new, if not new to the borrower. And so we're pricing that asset from inception, from the moment that borrower purchases the asset over the duration of the loan term. If it's a depreciating asset, then obviously we reflect that depreciation in our valuation, and we reflect it on a monthly basis, whereby we provide a valuation for every month of the term of the loan. So that way, if there's a default at any point, then the lender has to liquidate the assets. They know which value we've assigned to that asset in that given month.
Out of that bucket. Okay. That's
Exactly, out of that valuation depreciation curve. So that's number 1, is somebody might be getting a loan of some kind to do purchase financing, to purchase an asset. Number 2 is they already own the asset, and maybe they had a loan before, maybe they didn't, but they're looking to extract liquidity out of that asset because they want to put that capital to work somewhere else. Effectively, as far as we're concerned, the 2 are identical because all we're doing is coming in and looking at an asset and then valuing that asset over the course of the loan term. Doesn't matter to us if the asset is new or used or whatever it might be. It makes really little difference. What we do is value the asset according to the data that we're provided and the data that we have access to. So the nuances of the structure of the loan and the reasoning for the loan are not as important to us as they are what is the asset and what is the duration of the loan.
Gotcha. You kind of answered my next question, which was going to be around that guarantee. So what you're saying is, let's just say there's a used truck, right? And I'm making things up here, but you've got a used truck. You set the valuation and you sort of guarantee the valuation today, but you also guarantee it on a schedule going forward. So you say depreciation would be this on this asset. So therefore, today it's worth $100,000. Tomorrow it might be worth $99,500, right? There's actually a depreciation schedule by which you would
Yes.
stand behind, for lack of a better term.
Yeah, exactly. So
Okay, gotcha.
we're using the data we have available to determine the price as it is today, and then what we believe the value of that asset is over the next, like, let's say 3 years.
Gotcha. Excellent.
And then that's packaged in a guarantee that is backed up by our insurance partners, who are all A-rated insurers.
Oh, excellent. So you're the mortgage-backed securities of asset-backed lending.
Kind of. Like, what we're trying to do is and I mentioned this at the top of the call, we're sort of the AI valuation layer for all asset-backed lending, right? Like, we see our product as being a really important data point in any kind of asset-based lending that is currently missing. And so what we've done is launched that product with a guarantee to really as the tip of the spear to say, look, we're really good at valuing assets and we're going to guarantee that value. And anybody who wants to buy that valuation with the guarantee can do so. And if you recognize the risk transfer, great. But what we can also do, and we're now starting to do, is work with other partners who need that same valuation service. So some insurance companies have reached out to us who want to build, for example, a residual value insurance product based on our valuation capabilities, right? So they're using our valuation layer and then they're building their own products on top of it. Further still, other asset-based lenders are thinking to themselves, okay, well, how do I value the assets in my loan book, right? Like, and we see this in the news a lot, to the degree that I think it was a gentleman from Apollo, right? Zito, who earlier this year, I think it was John Zito from Apollo, if I'm not mistaken, he, in the press, there were multiple references to this where he's like, I literally think all the marks in this space are wrong. And that's a pretty bold thing to say, right? But if John Zito from Apollo is saying it, you got to give it some credibility. And I think people are coming around to this understanding that there is a bigger opportunity to be more accurate and more diligent in how you value this loan collateral. And that's really the problem that we're trying to solve here. But it's a very real problem.
Okay, excellent. So what's changing in the industry? Is there anything different than it was? I mean, this is not a new industry, right? But as you guys think about what's going on in the industry that you think the audience might have some interest in, is this thing dynamic, or does it really come down to the valuation we've already discussed? Making sure that if you're going to lend into this space, that your loan committee has a pretty good understanding of what you got yourself into and how you get out in the event that something goes wrong.
Yeah, that is a huge component here. But I think one of the other, there's multiple things happening with that within asset-backed lending, which I think are very interesting. One is one of the fastest growing sectors. Like it's 11, 12% CAGR, which is aggressive in $1 trillion sector.
And why is that, if you don't mind me interrupting? Why would this be a growing sector? Is it because it's not been lent against? I can't imagine capital equipment is growing.
Yeah, so it's a good question. It speaks to the second interesting thing that's happening. And that is, where is that lending coming from, right? And it's coming more often than not from private credit. So one of the knock-on effects or the after effects of the great financial crisis were sort of additional regulatory requirements around banks and how much capital they had to hold in order to be able to do certain types of loans, and asset-backed lending fell into that. And so the banks started to pull back from doing lending to small to medium-sized businesses who more often, they do rely on this type of lending in order to unlock liquidity, right? So that they can actually maintain an appropriate cash flow. And so the demand didn't go away. The demand was still there, but it was just unmet.
Okay. Yeah. So they couldn't get loans against the equipment or against a portfolio of equipment.
From banks.
Right. Okay.
So then, because markets are generally over time efficient, you see this emergence of private credit around the sort of early 2010s, right? Where it really, and it really starts to pick up more recently than that.
I'm going to stop you there because we prepped for this question, and I think in our preparation I said, I'm not sure that I understand what private credit means in that sentence.
Yes.
So could you just help the audience define that, right?
Yeah, sure. So effectively what happened was a significant amount of capital was held by private, either individuals or entities or family offices or that type of sovereign accounts, that type of profile, not a traditional bank.
Yeah, they moved it out of stocks, moved it into the fact that they'd be willing to lend against or use as a lending.
Exactly. So they're in this position where they're sitting on a cash pile and they're looking for yield and they're looking for opportunities to obviously gain greater yield than they might just sitting in some kind of passive fund.
Okay.
And then asset-backed lending presents a very interesting opportunity to get that yield, right? So if you start penetrating a space early on, if you start lending within certain sectors relatively early on, and GPUs is actually a very interesting example of that, you can command a higher yield than you would in other investments.
Okay.
And that becomes attractive to private credit, and it's attractive to the borrower because the borrower is like, okay, fine. I just want the cash. If I have to pay a premium to get that cash, that's fine because I think the way I use that cash is going to pay me more than the interest associated with the loan.
Sure. Okay.
So it's sort of, in many ways, this match made in heaven where private credit realized that there was this massive untapped opportunity that banks were neglecting, but the demand was still there and the yield was pretty healthy. So lending in that area, in that space, increased significantly. One of the and this is kind of one of the interesting unintended consequences of regulation, right? It's happened before and it'll happen again. Money moves to the less areas where there's less friction. Yeah. Highest yield and less friction, right? Yes. Those are two ideal combo. And lending out of banks is high friction and low yield. So you end up in this scenario where private credit has sort of jumped in to replace the banks and they're quite happy to take the returns. and they're not subject to the regulatory requirements, Basel III or whatever it is that all the banks are subject to, which means you can do deals much faster. The borrower is happier. Yeah, there's less overhead or less underwriting required. There's pros and cons to that, but that's effectively what I mean by private credit and how we ended up here.
Okay, so then let me just another sub question without going down a rabbit hole, but from a regulatory perspective, sort of what handcuffs did they put on them? Was it valuation? In other words, is the biggest handcuff what you're talking about that you do for a living, which is I can provide a valuation, I can provide the fact that if you'd sell it in 5 years, the exception of transfer costs, that thing will still, if I said it's worth $500,000, it's worth $500,000 at that point. Is that the regulatory problem that is preventing banks from having an appetite for this? Or is there something else from a regulatory perspective? Well, how can the private equity guys do this better than a community bank can?
Yeah, so it comes down to capital requirement, like how much you have on reserve,
And where you can lend them, and then
where you can lend it,
what sector,
how much you can lend, all of those types of things. And at some point, it just becomes more of a headache than it's worth for the bank. It doesn't mean that it's not possible. It just means that there's so much friction that they just don't like that kind of business. So they might still do some of it. Yes, yeah, exactly. They might still do some of it, but it makes it harder. And I think that is starting to change, in fairness. So we work with banks and lenders, and what we're seeing, partly because of our product, but also because multiple other factors as well, is that as the scale of the asset-backed lending, and again, sort of tangible assets, as the scale of that space continues to grow and more people are trying to sort of extract liquidity from their assets, it's getting to a scale where the banks are taking interest again. And they are saying, okay, well, maybe we can figure out how to do this, how to structure it, and how to meet the requirements. And when there are products that enable them to recognize risk transfer, which is, as I mentioned, what we're trying to build for what we have built for lending and banks are trying to recognize, then some of those requirements are met, and the ability to actually broaden or widen the profit margin becomes meaningful and impactful.
Okay, and in that sentence, risk transfer to the audience means I ended up with the asset and now I need to get rid of it for cash. Is that
Yes,
accurate, or am I thinking of is that completely wrong?
No, that's correct. So on their balance sheet, they're currently holding the risk of default and liquidation, right?
Yeah.
In that scenario, worst case scenario is they have to write that asset down to zero.
Got it.
But when you introduce a product like ours, then they don't have to write that asset down to zero because we're effectively promising the value is accurate.
I gotcha. Perfect. Okay. Yeah, there's probably another question there, but we'll hold it till the next time we do this. Because I guess the question I have that pops to mind, and maybe I misunderstood your answer, is their risk is that the asset went to zero on their books, or their risk is that they can't turn an, I guess I'd call it real estate owned, but in this case, an asset owned right by the bank into cash, because their goal is to liquidate, get out, be done.
Yes.
And maybe it's the same risk, but I'll use the example that pops into my mind. I bought a cotton gin from 1950.
Yeah.
Can't get rid of it.
Yeah.
It's a piece of equipment that we've lent against, but all of a sudden the guy shuts down his mill and I'm stuck with this piece of equipment that I can't get rid of. In your case, what you're saying there is that would both take the asset value on the books to zero, but effectively you'd have to call it scrap. Right, you're not getting cash out of it. That thing, that one, because you made the mistake and lent on that, that one's dead. But right next to it sits something that is sellable. That one.
I mean, in that scenario, before you do the loan, you're trying to understand what the potential resale value of that asset is.
Gotcha. That's where
and
the
if you're
guarantee comes in.
and if you determine that the resale value is zero, then you're not going to do the loan. But if you determine that there is a resale value, or Barker, for example, tells you that there's a resale value and then packages that in a guarantee and says, you know what, we promise that there's a resale value, then the bank says, okay, I feel more comfortable doing a loan. I'll do the loan. Okay. And then in the event that there's a default and we sell it, if it sells for less than Barker predicted, then that triggers a payout. That's where you can recognize the risk transfer of saying, actually, there is no scenario in which we write this asset down to zero.
Excellent. No, that's I appreciate that. That's a great description.
Sure.
Okay, so let's talk about movement, sort of, does market volatility have anything to do with this industry? Is there a broader picture, market moves this way and therefore your industry changes?
Interestingly, no, because in any market, you have people who want a loan and lenders who need to know what the value of the asset is before they do a loan.
Okay.
I would argue that in either direction, like if you're a lender operating in a market where there's a downward trend, you're going to be even more concerned about your downside or making a mistake. And if you're a lender operating in a rising market, then your demand, the amount of borrowers coming through your door is going to increase, and your exposure, therefore, your loan book size is going to grow, and you're going to be worried about the size of your loan book.
So it's more a shift, just like any of your ratios would normally require as a CEO of the bank or a chief investment officer, what have you.
Yeah, that's exactly correct. From our perspective, we kind of see ourselves as like good old-fashioned CYA product. I don't know if I can spell that out on your podcast.
Nope, we all understand it. Yep.
And I think that's where it's pretty compelling within the lending space, and especially within banks, because historically speaking, other valuation firms haven't been. You can turn around and say to your committee, if everything goes wrong, like, oh, I got all of these different valuations, but they're all different. Like, so which one did you pick and why? And you may end up in hot water because like maybe you picked the wrong one, or maybe they were all wrong, or any of those things. And what we're saying is like, look, we're not trying to replace those guys. We're trying to help you make an informed decision. And then we're going to back that up with a guarantee because we know we're right. And I think that's where the dynamic starts to change. And that's where people start to think about like asset-based lending in a more sort of stable manner, if you will.
Right. They can explain it to their board. They can explain it to, they know what the risk is one way or another.
Yeah.
Well, Thomas, this has been great. I really appreciate your input. I mean, I learned a ton. Hopefully our audience did as well. It's just so interesting for me to hear industries that are out there that I'm just completely naive of, right? So, and maybe not entirely naive. I understand equipment. I just didn't understand the complexities of what lending against these types of assets were really all about. So certainly appreciate your input on all of that today.
Yeah, thank you, Charlie. It was a fun conversation.
Well, thank you for joining us on BankTalk. Okay, well, that's it for BankTalk. Have a good day and keep on learning.
Thank you for listening to the BankTalk podcast, brought to you by Remedy Consulting. If you like what you hear, please rate, review, and share our work with others. Thanks again, and we'll see you next time.